Good afternoon or good morning, everybody. Welcome to another Lended FinTech webinar in partnership this time with Finicity. And my name is Peter Renton. I'm chairman and co-founder of Lended FinTech. And thank you very much for joining us today. We have what I think is going to be a fascinating discussion. We all know the pandemic has impacted credit risk. It's impacted underwriting. And there's, we have this unusual situation, really. I mean, we've used unprecedented a lot in this year, but when it comes to credit risk, this truly is unprecedented times where what worked last year simply is not going to work again right now. So lenders of all stripes have to adjust. And what we're going to be digging into in some depth today is how that lenders are adjusting and what are some of the best practices, what are some of the tools that lenders can use to help them underwrite as accurately as they did last year. So with that, I'm delighted to welcome Steve Smith, co-founder and CEO of Finicity, and Louis Nario, a partner of McKinsey and Company. So firstly, maybe Steve, just want to give a quick intro about what Finicity does real quick.
Yeah, thank you. Finicity is really a data access and insights company. And so based on consumer permission, we facilitate the access to consumer financial records and information, and then curate those or provide them directly to other services that utilize that information to create context and value for consumers in the way that they're basically subscribing to get value from that information.
Mm-hmm. Okay, and Louis, everyone knows McKinsey, but why don't you tell us a little bit about your role there?
Sure. Thank you, Peter. Yes, I'm a partner with McKinsey. I've focused most of my work there in the various areas of credit risk management, and perhaps focused in particular on credit risk analytics. And since the advent of this particular crisis, I've been spending quite a bit of time with clients on what they see as changes and what we see as critical changes to the credit risk environment, and what people are doing about it, down to the level of how to assess individual consumers and companies.
Right. Okay, so let's get right into it. I want to start with a Wall Street Journal article from a few days ago that talked about credit scores and how they're at record levels. But we all know that that's not really a true indication of where the consumer is at, because let's face it, we know that that there's a lot of people struggling in the pandemic. So why don't you talk about, just give us a quick overview, Steve, on how you see the pandemic impacting credit decisioning today.
Yeah, I mean, obviously we're in unprecedented times, as you've said. We've used that word often. But there really is not a playbook for most of us with respect to what a global pandemic means and impacts that they might have. Clearly, the acceleration toward digital is significant, and I'm sure we'll talk quite a bit more about that here today. But a couple of the impacts here that are really interesting. First of all, the average credit scores have gone up since the beginning of the pandemic. But if you think about that, and unemployment has gone up, in unprecedented ways. I mean, we've seen a rise in unemployment that a few of us ever thought was even possible in that short a period of time. And so, how do you reconcile those two things? And what's happening here, obviously, is there's a lot of stimulus money flowing in and assistance flowing in to help people on a short-term basis. And there are also a lot of payment holidays that have been afforded to consumers with respect to some of their major debts. And so when you have a credit reporting system that relies on, consistency of reporting and isn't focused as much on things like cash flow and income, absolute income, then you would tend to see this kind of short-term kind of impact if you just run the numbers and understand how today current credit scores are calculated. And so it's really, really an interesting challenge, I think, given the fact that, lending decisions tend to be, for a longer period of time. You have to think about, not just what you're looking at today in this instance, but what the real impacts are and what the real data would reflect, that would demonstrate a person's propensity and ability to pay, any particular loan over a period of time.
Okay. Yep. That sounds good. So, Lewis, I want to switch to you. You recently, McKinsey did this excellent report, actually, managing and monitoring credit risk after the COVID-19 pandemic. And in that report, you talk about, the crisis has triggered 5 major changes to the credit risk environment. Could you just run through some of those changes that you've seen?
Of course, and a lot of it is quite related to what Steve was already mentioning, right? The first thing, and most obviously, there are changes, right, induced by the pandemic and the related economic disruption, right, on creditworthiness, whether it's for companies or consumers, and that those impacts vary significantly from region to region, sector to sector, and even individual to individual, right? So that's like any other economic crisis in the making, this one has had an impact, but this one is peculiar in the way that is distributed, right? The second one is that because of all of the effects that Steve was mentioning, the payment holidays, the government support, it has become very hard to differentiate between individual borrowers. It's certainly true at the consumer level, also to a degree true for firms, particularly small businesses. So the playbook, the data we had before has become obsolete, and it is hard, right, to make those differentiations now in circumstances where, as we said, there is a disruption, right? Comes down to data then, number 3, right? So the data on conditions as they evolve is scarce. The data that we used to rely on is typically more lagging. It relies on factors that are not going to be as updated as frequently. And so banks are scrambling or putting on really high gear their programs to try and make sense out of more frequently updated data, particularly, say, account behavior. Right? And then the last 2 are, well, as a result of all this, there will be a need to work through problem loans. So there's going to be individuals and firms unable to manage their debts. Right? So banks in the U.S., after a long period of relatively benign credit conditions, have to up their game on that. And in particular, given the dimensions of this particular crisis we're going through, and given customer expectations and preferences, there's a real need to be socially responsible in the way banks assist and lenders generally assist customers in need of support and help, right? And then again, the old playbooks are not what is necessarily needed.
Right.
I hope that helps.
Yep, for sure. So we've obviously seen changes in behavior of consumers. I mean, there's obviously been a lot more, there's a movement to digital, people doing digital banking, mobile banking for the first time, millions of people doing that, touchless technology, really popular, contactless payments, that sort of thing. So maybe Steve, we could just go back to you and talk about how is this changes in consumer behavior that we have seen? How's that impacting, finances in general, and in particular credit decisioning?
Well, I think at the core, right, every financial services entity, every entity providing financial services is having to take a hard look at how they engage their customers, because the playbook is suddenly and significantly changed. The number of people, for example, going into a branch versus those that are using, mobile or online banking for the first time to do major functions, including deposits and payments and the like, has increased significantly. Those that might only consider going into a branch or into a bank to open an account, are now in a place where if you want their business, you really have to facilitate digital account opening. And for on the lending side, you know, where you may be taking an application in the past, you know, face to face in a branch, or, you know, at a mortgage loan center, or, you know, somebody who is just much more comfortable sitting down with a broker or somebody, because that's the way they've always done it. They're now in a place where, you know, for the first time, they're interacting online, and they need the set of tools to be able to really facilitate that process. And so I think everyone in the financial services industry would say to you, wow, we knew digital was coming.
Right.
We just weren't really prepared for how quickly it was going to be thrust upon us.
Mm-hmm.
I get, you know, in our world, we look at it and say, we could have advanced, we may well have advanced digital financial services by 4 to 5 years as a result of the pandemic. And how many people had a playbook, you know, at the ready that said, well, here are all the steps you need to take to skip the next 4 to 5 years and be prepared for what's going to be coming in terms of volume, in terms of, you know, frictionless lending, in terms of, you know, the data sets and the elements that you need at the ready to make appropriate decisions. And you know, while while the world of open banking, open finance is making significant progress, you know, the need for that is absolutely, I think, defined and significant now in ways that were really difficult, you know, for a person who's, you know, an entity who's deeply steeped in it 18 months ago to really catch full attention and interest in. But today it's, you know, when we're talking about removing friction and getting to a streamlined digital process and being able to engage your customer, you know, where and how they need to be engaged, it's a very, you know, kind of active conversation, both in what's the digital experience and how does it empower, and how does it remove friction, and what additional data elements and sources are needed to really facilitate a full digital solution.
Right. And I imagine, I mean, just turning to you, Lewis, I imagine that obviously there were some companies better prepared than others. I mean, how have you seen with your clients that have come to you to say, oh my goodness, we weren't ready? I mean, what differences have you seen in the market from those that really were? You know, there's obviously more digitally native type lenders out there, and there's a lot of traditional ones. I mean, what's been the disparity?
Yeah, it's an excellent question. So I think the even within the established banks, the range of practice in how digitally advanced they've become, and how much they had already invested in the overall 360-degree understanding of the customer and their experience. That there's quite a big range there between those, right, within that space. And unsurprisingly, there's a high degree of correlation that we observe between the way in which the bank had approached that understanding of clients' overall customers and their needs and matching their experience, as Steve was saying, when and where and how they wanted to engage. There's a correlation between that and how well prepared they felt for the pandemic. And it comes down to things like, the more we understand the behavior of the customer across the different products and connection points and modes of interaction, right, the more we feel we know what is going on with that customer, right, versus flying blind. Given what is happening with the economy and government support, and sort of just recording that we continue to receive payments is a good thing, but not nearly as informative these days as it used to be. And whereas if we have engines that are recording and analyzing what's going on with their various accounts, with their touch and reverse searches, that gives the bank a much better window. And a lot of that was developed geared towards improving the customer experience, being able to provide pre-approved credit lines that moved between different products as the customer decided versus various different lines of business in the bank deciding and taking independent action. But it has really come into its own as a way of approaching the overall situation with coverage. So, the flip side, of course, is that the situation has exposed weaknesses, right, in the way other banks have approached, or the tools they have, the more traditional and certainly perfectly adequate until recently, right, tools based on traditional scoring approaches and fairly siloed product views, right? And we see clients making probably more progress over the past few months than they had in the previous years, right? In accelerating those transitions and those programs. So, silver lining, if you will, right? For the industry, definitely is stepping up to the challenge.
Right. So let's dig into those tools a little bit, and I want to, Steve, I want to get your perspective. Finicity's been a real pioneer in a lot of these, open banking tools that can really help in the credit decisioning process. And they've certainly been, obviously you've had clients that have come on board not just in the last 6 months, but in the last several years. And I wanted to sort of dig into the innovations that you've made and how you're talking to your clients about the tools they should be using when they can't, like as Lewis just said, they've relied on traditional credit models that are very backward looking and don't reflect the current reality of today. So what are the tools that you can sort of help lenders get a more accurate picture?
Yeah, it's really an exciting conversation because economies obviously will ebb and flow, and we'll see downturns and major challenges and significant periods of prosperity and wealth generation. And arguably, we've just come through one of the greatest periods of that over over the years. But it wasn't too long ago, and I certainly remember the last downturn. Coming off of that. That downturn, and where such a significant amount of wealth was lost, and there were there was significant write-offs from a credit perspective. One of the studies that was done, it was an MIT study, was to analyze the credit kind of credit scoring and underwriting process and determine if additional data sets at that time would have been helpful. So we believed that was the case. We leaned into that. We certainly looked at some of those studies, and not surprisingly, the consensus was that if you were to use transaction-based data together with standard credit scoring, that you would have been able to address the issue of acceleration. The problem is acceleration. The challenge with the way scoring works, and Lewis, you talked to this a bit, but it's about the lag. It's both the lag on the downside and the lag on the upside. Just the way the score is created and generated, you don't see quickly enough the impacts to the downside and the significant increase in risk. But if you add transaction data to that and you look at things like impacts to income or cash flow at the same time that you're looking at propensity, payment history, and some of the more traditional usages of credit and some of the more traditional mechanisms that are used in a credit score, then what was found in that particular study, and certainly what we've demonstrated since, is that you address this issue of acceleration both on the downside and the upside. So in the upside, you don't want to be punitive, right? And you certainly want to afford credit to those who deserve credit at the right price and match it appropriately with the risk. On the downside, you don't want to be adding fuel to the fire and putting someone in a position where they're going to have significant credit challenges or struggles, or you're going to put your institution at risk because you're taking risk that that isn't appropriate given the current that current micro dynamic, right, of that particular credit decision. And so, on the heels of that, we just looked at it and said, well, open banking is really that's really the enabling technology and solution set. So in an open banking environment, a consumer can permission access to their transaction-based, their financial information, including payroll data, transaction-based data, et cetera. And that data can be used, on their behalf in a credit decision. So the critical pieces that come out of that when you get into an underwriting scenario like today is that you can take a look at cash flow trends over time. You can look at, spending behavior over time. You can certainly look at verification of income. 93% of all all wage or salary earners in the U.S. have a direct deposit, right? So it's income directly deposited their account, and so these are indicators and pieces of information that can be used to help not only determine appropriate sizing for credit, or to determine that risk that might be too significant, but also to ensure that the credit score is not being punitive. That in many cases in the past, if you look over the last a series of years, in many cases there were a number of people with thin file that weren't getting the appropriate treatment from a credit scoring perspective that really reflected their financial capacity, their propensity and capacity to pay, because there just wasn't enough information on them. Right. And so in that case, it's punitive. And in another case, because your income has been significantly impacted, because your cash flow has been significantly impacted, taking on additional debt in that particular instance, is probably not the right decision. And hopefully, we can find ways to provide assistance in the right ways, to address those kinds of circumstances. But that's really the key advent is, in a world of open banking, consumers are now empowered to provide access to financial information that can be used not only to help them manage their money better, and to make better spending decisions, and with personal financial management tools and wealth management tools. And there's a plethora of solutions out there that are powered by consumer permissioned access to transaction data, but also to lenders who are making critical, lending decisions based upon information that can be used in that context, and very helpful.
Right. It almost seems to me that transaction-based data has moved from a nice to have to an essential part. I mean, I'd love to get your, obviously, Lewis, you're a bit more kind of objective here. Can you, what is your sense? Is transaction-based data an absolute necessity for underwriting today for consumer loans?
I would think so, yes. I mean, it's been a while that leaders, both leading thinkers and leading institutions, recognize the power of transaction-based data, right? And to some extent, in pockets of even the sort of more traditional banking world, some of this has been implemented for a while. So those from a credit card extraction have much more of a sensitivity to transaction data, spending patterns, than those from a auto lending or mortgage extraction. I mean, so in the U.S., right, within consumer finance, there's pretty significant differences the way people have built their models and their approaches, even within consumer finance by product, right? What has been identified increasingly is the power of pulling all of that together. Even within an individual large institution, they're going to have data on customers across their deposit accounts, their credit cards, their auto loans, et cetera. And somewhat shockingly, banks weren't exploiting the power of bringing all that data together and analyzing the transactions. Right now, all of that has changed, as was already changed, and this has really sort of kicked life into it. Right, that's, as you say, it's a must-have to have that complete view, and then the additional layers, what Steve's talking about, which is the the open banking, the ability to go beyond the confines of an individual institution, the incredible power that that brings to the consumer, to alternative players in the market, and ultimately all that back to the benefit of the consumer of having different options. Right? So yes, I completely agree that it's going to be an essential as we project forward. It's going to be hard to imagine, leading tools without this. Now,
Right.
between here and then, probably things will normalize a little bit, right? Open banking in the US is not the same thing as in the UK, right? And so this is not like a complete, exponential snowball, but if we look 5 years from now, we're going to look back and say, yes, things have changed.
Right. And just on that, I know that I'm not sure, I think it was 2018, Steve, you can correct me if I'm wrong, that you guys partnered up, I think, with Fico for the Ultra Fico score. And that's really, this is obviously pre-pandemic, but, giving, basically allowing consumers to sort of, contribute some of this data. I mean, maybe just can you talk about that for just for a minute, and how that partnership kind of has helped accelerate some of what you've been talking about?
Yeah, obviously, we jumped into that certainly much sooner than 2018, but coming, kind of into the 2016 timeframe, started really together with Experian and Fico, looking at the impact of transaction data and how that could be helpful. It all seems incredibly obvious now, but
Right.
at that point, we were really leaning in and saying, is it possible for you to take transaction data and model that, cash flow, for example, or average account balances, a number of different attributes that can be associated with transaction data, to the risk modeling or scoring that's been done, say for a FICO 8 or a FICO 9 score, and so actually, run that in a way where you can correlate a score based primarily on cash flow to the way that the same person, given a number of trades and credit history, would score with the same kind of scoring model of FICO 8 or FICO 9. And so that was the advent of Ultra FICO. It was the ability to take someone who has a current credit score, or someone who's credit invisible, or someone who's got a score, but it's a thin file, meaning they don't really have enough trades to make it a meaningful score, and then contribute their cash flow information, and then through that cash flow information, do the calculations around attributes that could then be fed into the scoring process, and a relevant, score could be generated that is consistent in kind of the scoring methodology. In other words, this person, with this degree of risk in a full credit file would have the same score if we took a look at their cash flow. And then, for somebody who might be impacted negatively by the fact that they don't have enough trades, does that allow us to get a much better reflection of that credit risk? Right. And what is the lift in terms of the ability, once you add that transaction data, what's the ability to separate, the enhanced ability to separate good from bad, right? Which is really what we try to understand. We try to understand risk that's real and significant, and we try to separate away from that those who really don't represent that same risk and would be an appropriate risk for lending purposes. And that is the Ultra FICO score. Essentially what happens with that is, a consumer can permission access through the Finicity platform to their financial information. Finicity pulls that financial information, creates an attribute summary report with 133 calculated attributes that feeds into the FICO scoring engine on top of the FICO scoring capability. And so you end up with the Ultra FICO score, which is basically, we'll take all your credit history that we have, and then we'll add to that,
right,
the attribute information that comes from the cash flow, and will provide what we believe is a relevant score, on the same, kind of scoring metric as the as a FICO 8 or a FICO 9. So that was that was really revolutionary in terms of really the concept of melding those two pieces of information together. And frankly, credit scores aren't going to go away tomorrow. This is not something that we're going to see a wholesale change overnight. But I do believe, as he said, 5 years from now, when we look back, you're going to see the inclusion of cash flow analytics and verifications that come through, the ability to look at not only the on-us data that a bank has or a financial institution has, but the 360 view and the held away data to really get an appropriate view. One of the other products that's out there that Finicity has partnered on is the Experian Boost product, which comes at it from a different perspective, but brings transaction data together with a scoring with a person's credit file. And in that particular case, it's about adding relevant trades, to the credit file. So this is very helpful for somebody that, for example, has a thin file or is even credit invisible, and we can, through their transaction data, determine the utilities that they're paying consistently, the mobile phone payments that are being made consistently, even some of the streaming, the things that are being made consistently. And under a FICO 8 or FICO 9, those scores can incorporate utilities and phone payments and the like into the scoring process. So in that particular case, the consumer again becomes involved in the process and actually is empowered by providing permission to access to information that can be actually included within their primary credit file.
Yeah, I've seen those Experian Boost ads during the football games on the weekends quite regularly this year, and it is great that you see that people saying, "Oh, I increased my score by 13 points, by 20 points, whatever," instantly just by adding in some of the things you mentioned there, the trade lines that they have. But anyway, I do want to just focus on one piece, and maybe Lewis, you can attack this one. It's consumers connecting all of their transaction data. It all sounds great from a lender's perspective, but we do live in a world where people are aware of privacy issues and just data breaches and all that sort of thing. How do you feel like how does the consumer feel around giving all this access to lenders of their, let's face it, if you give your transaction, some of the transaction data in there is probably somewhat intimate. How should lenders think about privacy, and how are consumers thinking about it?
Yeah, so look, I'm endlessly surprised at the personal level by the willingness of consumers to give access to their data in exchange for benefits, right? And so I think that the challenge from the point of view of institutions, right, regulated institutions and institutions who have a significant need to protect their franchises and their reputations. The challenge is to live up to the trust that customers are and will probably continue to place on them, right? So I mean, none of what we have said detracts. In fact, everything we have said adds to the challenges or the burdens that banks and other members of the ecosystem face, right, in having to protect their data security, have clarity of policies, follow them strictly, and so on. So I think it's something that we're going to continue to see evolve. We're going to continue to see breaches as we have seen in the past, and we're going to continue to see hiccups as we go down that path. But I don't see a retreat from that, at least personally. I think all of the events that we've seen have forced institutions and firms to invest more and be sort of more strict in how they do things, but they have not put innovation into reverse, right? They have not, right? So that question is intimately related to the question of regulation, which I think we also need to discuss, and especially in the consumer finance, consumer protection, right, arena. The use of the current tools and the current credit scores has all sorts of limitations, not least in terms of the somewhat adverse effects on financial inclusion, just by the way in which they are constructed and have evolved. They have all manner of limitations and concerns, but they are, they have been used. They are being used on a regular basis. Their use is accepted. Right? It's accepted by regulators. It's accepted by public opinion. So changing that does convey some risk to lenders, right? And regulators are, they're very interested in the potential for the use of new data. They're very interested in the potential for the use of new techniques, AI, machine learning techniques that often are necessary when dealing with the complexity of the features that come out of this sort of data. But regulators and banks for sure are also cautious, right? And there's still areas of some degree of uncertainty and risk, for example, in fair lending. Or unforeseen biases in some of the techniques that can be used to analyze the data. So there's certainly the data security and cybersecurity concerns. There's also some regulatory reputational sort of model methodology risk concerns that are still out there. But the work of the industry, of the regulators, of the ecosystem members, such as Finicity, of course, is to help address those and put, continue the innovation going, because the prize, again, not least in terms of financial inclusion. I mean, the prizes are huge. Right? So
right.
But there's wide-eyed. I mean, there are risks and things to work with. I don't know, Steve, what you've seen. But,
yeah, I would just say, to your point, Louis, the benefit outweighs the risk. The industry and consumers are largely moving in concert based upon that theme. The trust that consumers generally have in their financial services providers needs to be maintained, is essentially being banked on today, and needs to be maintained. And I think that largely the industry is taking a very responsible approach here. I mean, in our conversations, and Finicity is a co-founder and helps lead the financial data exchange that now has 153 members across the industry, fintechs and financial services organizations, the largest banks, a number of individual thought leaders, and helping to create the standards, for data access, the standards around consumer permission, the standards around transparency and security and full access and control. And all of those are really critical and key elements of success. And those that are participating in the industry, I think, understand that. And last year there was a joint statement from 5 of the leading regulators that essentially said, you ought to be using this kind of data in your analysis of extending credit to consumers, but you need to make sure that it's done, in compliance with FCRA and in compliance with the Equal Opportunity Credit Act. And so there's responsibility that goes along with that as well, right? To Louis's point, it's, are you holding yourself up to that standard? Are you actually complying with the standards of equal opportunity and fair credit, and essentially providing and affording the same protections to consumers that they would have expected, from a prior kind of credit underwriting process. So I definitely see that, and I see responsible players coming to the table and working together to really create a safe environment, both from a security and access perspective, as well as a credit, safety and security around credit.
Sure. And I just want to remind everybody, we've got a few questions coming in. If you want to ask a question, I'm going to get to that in just a few minutes here. Before we do, though, I just want to talk about kind of, like, where do we go from here, insofar as, like, it's great that we can have, really, I think transaction data can give us a clearer picture on people that we already would have lent to in the first place. Just gives us a bit more clarity. But we have touched on it, but I want to talk about sort of bringing more people in, and as far as like in a financial inclusion way, because that's really what a lot of the regulators want. They want to, they want the people who have a thin file or who are outside the credit system to be able to access credit. And so how is this providing more access and like, as in today, and how maybe you can talk about some of the lenders that are using this, that are really expanding their the access to credit they provide.
Yeah, I mean, Liz, you're probably talking to organizations every day that are dealing with the 53 or 55 million people in the U.S. that fit under this thin file or credit invisible status. And to think about that, one of the most developed countries in the world, perhaps arguably the most developed country in the world, and the fact that we have 53 or 55 million people that find themselves outside of the credit envelope, or at least an opportunity to be fairly evaluated, is incredible. And then you apply that to kind of a worldwide stage, and it becomes a really interesting kind of conversation. I love to talk about financial inclusion because it's really at the heart of Finicity. It's been part of our mission since our founding, and continues to be part of that mission and focus today. It's financial inclusion is going to come through the advent and the continued push into digital, the ability to open an account from anywhere and to be a part of the financial system. The ability, once you've opened an account on a mobile device and you have access to the internet, to have that data utilized to help evaluate your credit, your propensity and ability to pay. Some of the numbers that that we have reviewed, and some of the studies, and Louis, I know you've looked at these as well, but as many as 30 to 35 million of those 50 to 55 million that are in the credit invisible, credit thin file could be helped by utilizing access to their financial transaction data. So, appropriately scored, risk rated, brought into the financial system, and given opportunities for appropriately priced access to credit. That starts to, those are some of the fundamentals that our economy and our opportunities as a country are built on. And I think that that it just represents significant opportunities. So some of the more progressive lenders are actually leaning in a lot here, and utilizing this information to expand the credit envelope and really evaluate those that have been outside that circle. And those outside the U.S., you take a look at a number of countries that are using, digital and open banking to extend banking capability to millions, and you start looking at what could be, in the next 5 to 10 years relative to a kind of a worldwide push toward overall financial inclusion. It's very exciting.
Mm-hmm. Yeah, I couldn't agree more. And I also agree, Steve, with some of the numbers you cited. I think there's 15, 20 million households that maybe could be helped by expanding the use of data, and the way in which their data is being used to paint a proper picture. I don't want to underestimate the challenges, though, the particularly regulated banks face in making sure that they're able to safely and reliably use that data. But the potential is huge, and that's what you and others, and obviously ourselves, are engaged in to make that happen.
Okay, I want to get to audience questions. We've got several coming in here. If you want to ask one, please hit the Q&A button on the bottom of your screen. We've got two questions here about alternative data, so I think we need to address this. What do you think about the usage of alternative data? And they're defining it here: social media, mail usage, apps usage, mobile phone data into credit models. Is there any ethical implication about that?
Louis, you all taking a look at that?
I'll start. I
Yeah.
mean, so yes, of course, right? This is the answer, but not all alternative data is the same, right? So I think one needs to really go through a checklist, if you will, right? You start with rental payments, utility, and phone payments. Sort of maybe if you've had a small dollar loan somewhere. Maybe you've had medical bills, et cetera, right? Of course, demographic data. And then you start getting into sort of geolocation, where have you been type of data, social media and networks. And you see a lot of innovation in China, for example, using things like network, right? Like if you are closely associated with people who have
I'm still live.
Okay. Okay. Yep. I think we lost Louis. In fact, I know exactly what he's talking about there. With some of the things in China have been they've supremely sophisticated about geolocation data and that sort of thing, and it's it wouldn't be allowed in this country. Some of the things they're doing in China,
I think to his points, there's a lot of data that just makes sense, and I think again if you take a look at the statement from the 5 regulators, the joint statement, it's right down the middle. It's the financial information and data that Louis was talking about, the payment of certain bills and income related data and verifications, those kinds of things. When you start to get into social data and other data that sits outside of kind of your interaction with finance, and the further you get into that, the harder it is to really answer that question with clarity. Some countries like China have used information, including as Louis was saying, kind of your network to help get there. And other countries are leaning into some of those kinds of models. But here in the U.S., certainly, I think that the use of alternative data as it's defined more broadly, which tends to be more social data outside of financial transaction data, can be a bit problematic.
Yes. I mean, Louis, we lost you.
You lost me mid-sentence, but it's from what I heard Steve finish, I think we're going in the same direction. I mean, not all data is the same, and some of it is more problematic, and it's a risk return, right? At what point does the benefit you get from it not outweigh the privacy and other concerns that are there?
Right. And what I'm seeing too is I see a lot of lenders using some of this alternative data really for fraud detection. Some of it would not pass muster on a regulatory capacity to underwrite, but you can certainly use it to make a case for, if you can see if someone has is a real person kind of thing.
Yeah.
Okay. We got many more questions here. You mentioned open banking tools and transaction-based data. Which are the best open banking tools, and what are the most transaction-based data which is less invasive?
Yeah. So I'll lean in there just a little bit, and interested in your feedback on that as well, Louis. But hey, it's here in the U.S. it's a bit different model than what you see in other geographies in the world. As Louis said earlier, we're taking much more of an industry-based approach here in the U.S. today, recognizing that we may well need regulators to help provide some definitions or some guidance around areas where it tends to be a bit more gray. But in terms of access and creating appropriate tools around what we understand today, the financial data exchange actually has developed and is continuing to maintain an industry-based standard for access and control. It's the API FDX API 4.0 is the current version, and essentially provides the specification for standing up an API server, at the bank to handshake with, permission parties into that server so that access can be granted, and that's all done using OAuth as an authentication mechanism, which means that the consumer is really brought to the bank for authentication, and then a token is passed to the authorized third party that's accessing the data and utilizing that for credit decisioning, or utilizing that for lenders who are partners with an organization like Finicity, or utilizing that for a fintech application, a PFM or a wealth management tool, or whatever. And Finicity has, worked with a number of lenders and a number of banks today to implement those direct API connections, and that really is best practice, industry best practice in terms of what's available today.
Right. Okay, another question. Are there any resources that you recommend for staying up to date on the development in open banking uses of data, US-based standards and practices, etc.? Obviously, we have this. This is a resource that we will continue to provide at Lendit, this sort of thing. But maybe, Lewis, do you any resources? And Steve, you're happy to jump in too if you want. That you can recommend.
Yes, I mean, well, we regularly publish our observations on the state of the market, the key developments, whether they are more on the technology and data side or on the process and credit trends side of things. So we obviously provide such a resource. We also do research and publish on what is going on with fintechs in the space, and in particular the credit space. That's another source of seeing what is happening. Of course, industry associations are very active in this space, and Steve, of course, mentioned a couple of them as well. So there's a number of different sources for that. Perhaps not as exploited as they should be, right? Given that we all tend to live in our own institutions sometimes. But I know, Steve, I'm sure you have other suggestions.
Yeah, I think that in addition to your organization, Lewis, and others that are actively engaged in both reporting on, doing studies in, and providing resources around open banking, you do have these industry associations, and clearly, obviously, as an organization, Finicity provides input and insights into best practices and case studies and things that we're seeing for different use cases. But Financial Data Exchange also does that, and I would just suggest here in the U.S., if you haven't become a member of the Financial Data Exchange, it's pretty simple and straightforward, and you can get access to all of the work, or even participate in some of the working groups that are helping to define those next use cases and aspects of those use cases and data elements that are very helpful to power those use cases. So you can become an active participant in helping create what's happening in the industry, and stay 100% abreast of the latest and greatest.
Okay, another question here. It says it's really more about how open banking is actually accessed. So the question is, does open banking solutions grant access to multiple accounts across different financial institutions, because consumers are increasingly have many financial relationships with shallower info?
So the way that works is, if you partner with an organization like Finicity, we maintain the connection points. We have both legacy connections to, up to, 10,000 plus financial institutions and services companies here in the U.S., as well as the new direct, API-based connections that we've been talking talking about. And so in a partnership with an organization like Finicity, that would allow a consumer to permission access to any one of their accounts at any one of those institutions and bring all of that data in together. And that's essentially the service that, you know, an organization like ours provides.
Mm-hmm. Right. Okay. Another one here. Have you seen wide adoption of Experian Boost by lenders? Do they use boosted scores for credit cards, mortgages, other lending decisions?
Yeah, so I don't know if you all have done any research or work on that with Experian. Typically, I can tell you that there's wide adoption at the consumer level, and I think that you know, as I've talked to risk leaders with financial institutions, just like any new model, risk model or data set, you know, there's an obligation on their part to analyze and understand and correlate, and then determine how to best use in their underwriting practices. And so I would just say that I know that those discussions and that activity is very pervasive around Boost and, you know, other just attributes coming into the scoring process.
Yeah, I would agree with that. I mean, a bit along the lines of what I said before. I mean, the adoption is not instant, right? Absolutely, as Steve said, especially large institutions have an obligation to assess what additional information these attributes contribute, whether they can be used, and then to start using them when the cost benefit so recommends, and the benefit can have different forms, not just better differentiation, but also improved access to certain underserved populations and so on, right? So there's definitely work being done to assess those. But like I said before, institutions tend to be conservative. So that it's as well, there's going to be a chicken and egg. The more consumer adoption there is, and that's where I think you're right, Steve. The enthusiasm that consumers are showing is important. The more lending institutions are going to find confidence that they have sufficient numbers, sufficient demonstration, and the track record is going to prove itself out. So, but yes, I think there's definitely something that is here making waves.
Right. Well, we're running out of time, but I want to get you both to answer one question before we go, and that is around, you've talked about, we've seen 4 to 5 years of real development in the last 6 months, and so it's really a two-part question. Will this maintain, and then where do we go from here? Like, what are the next developments when it comes to open banking with credit decisioning? So, Steve, we'll start with you.
Yeah. So first part of the question is the train has definitely left the station. We're not going back.
Right.
It's a bit of a forcing function, and a lot of discomfort around a forcing function often, but the benefits associated with digitizing the financial ecosystem and the solutions that come along with that are real. They're significant, and it's not just significant on the part of empowering consumers and providing them with more solutions and capability and access and resource. It's also very much a benefit for those that are leading out and and moving as rapidly as possible to providing a full digital solution set. And I mean that it bears out in their success metrics, their key performance indicators, and a number of other things that obviously their shareholders uniquely interested in. So, that because the benefit is so significant on across the board, kind of 360, I don't see us ever turning the clock back. What do we have to focus on? Well, I think, the forcing function has really uncovered a number of areas of opportunity for the industry. First of all, the importance of open banking. We clearly have to continue to lean in there and continue that process of creating industry-wide solutions, absolute access, and remove the friction around that, and add some of the clarity that's appropriate. Second, and I think on the part of all technologists, fintech companies, and financial services organizations, the real focus needs to be on continuing to empower the consumer, and focusing on what enhancements, what innovations, and what solutions now need to be brought to the table to maximize the value proposition and the real benefit to the consumers and small businesses and society generally. So
Right.
I think that's, when you've been kind of forced into that world, those are the things that you're now facing into and understanding, where you probably were thinking about some of those things significantly before.
Right. Okay. Hey, Lewis, last word at 30 seconds. We're over time, but
Yeah,
briefly.
I think, look, how lenders manage the next 18, 24 months and the difficulties those are going to stay in people's minds for a very long time. And if we can have this type of approach come into its own and help make better decisions and help support those in need, right, at the same time, and increase inclusion, that's going to have been the turning point, right? But it's a rocky 18, 24 months ahead of us.
Right, I know it certainly is, and we didn't really get into that, but really just a fascinating discussion. Steve, thank you, Steve. Thank you, Lewis. Thank you, Finicity, for sponsoring this talk, and I hope everyone got a lot of it. Thank you to the audience. Sorry we couldn't get to all the questions. I know we had a huge number of questions coming in, but I think we covered a great deal of territory today. So with that, I bid you a good afternoon. Thanks.
Thank you, Peter. Thank you, Steve. Bye-bye.